In this presentation, we will compare reports from two QuickBooks systems using the same data. The first system using two separate QuickBooks accounts, one to track the business information and the other to track personal information, also having separate bank accounts to do so. The other using one QuickBooks account to track both business information and personal information, using only one bank account in order to do so. For the second month of operations, the month of February. So we've entered data for both January and February at this time. Here we are. For more accounting information and accounting courses, visit our website at accountinginstruction.info. On the QuickBooks homepage, we currently have the open windows open. We're currently in the business and personal account. So this is the account that combines both business and personal. We're going to be in this account and look at reports from the other two accounts that we have, the other two accounts being the data that would be entered, one in a business file and two in the personal file. In other words, this is the QuickBooks account that has both of them combined together as if we had one QuickBooks file and one checking account that we then use to break out between business and personal. We will compare and contrast that to the other system, which would include two separate QuickBooks accounts and the reports from them, one QuickBooks account for the business, one QuickBooks account for the personal. So to take a look at this, we're going to go to the view and take a look at the open windows to make sure you have the open windows tab open. And then we're going to go to the reports drop down up top. We're going to go to company and financial, and we'll take a look first at the profit and loss by class. Let's go to the profit and loss by class first, because that's really where the action happens here. So we're going to say that this is going to be for the second month, 02/01/20. So February 1st through 02/29/20. So there's 29 days. So that's February 1st to February 29th, 2020 is the year we worked in. So this report will give us the full detail within our system that has business and personal. It's not the nicest looking. We could format this report and sort it and filter it in many different ways, but this will give us the information from the business and personal side that we could first just at least compare to the data that's been entered into the other system, one business, one personal account. So first we could just take a look at the net incomes down here and see if they tie out. So if we go to the business and personal data, we've got reports. We'll jump back and forth. Now, one of the benefits, of course, of having them both in one account is that we don't have to open and close different accounts. And if we're using like software we have to pay for, like an online version, you'd need to pay for two different softwares. Whereas if it's a desktop version, then you can really do two accounts and have two files and not have a problem with the added payment, but you'll still have to jump back and forth between the two files versus not jumping back and forth. So here's the P&L, profit and loss, from the business account if we entered it just solely into the business account. We're breaking this out by January and February, so we're concentrating here on February. And if we scroll down, we get the 3,073. If we take out the trusty calculator here, we're going to say this is 3073 plus. And then if we go to the profit and loss for the business, and let's see if we can do the same thing. This is the month of February, profit and loss for the personal account. This is the personal account. And if we scroll down for February, we've got the net income plus the 7,897, and that's 10,970. If we entered it the way we entered it here, all into one QuickBooks account, we have the profit and loss of the 10,840 between the two of them. If we subtract that out, minus the 10,840, it's 130 difference, and that difference is due to the money that we paid out of the business account to the personal. And in other words, if we go back to the profit and loss personal, we'll see the 130 right here, and we're going to say that that is income from the business. In a sense, we've recorded that two times because we recorded it as income on the business profit and loss, and then we recorded it as income when it came over to the personal side. And the reason I'm doing that here is because we may want to do that from a cash flow basis, meaning if we're using our profit and loss here as a measure of budgeting tools, which many personal side businesses will do, I want to know how much money I'm really being able to pull out of the business onto the personal side so that I can make my budgeting based on cash flow. So that's the reason for putting this 130 here rather than we could just track it on the balance sheet item in equity or in a liability account or in some account on the balance sheet. So there's pros and cons to recording this 130 on this side, but it could help from a cash basis difference. So that's going to be the difference that we have between the two methods so far. Obviously, if we go back to QuickBooks where we have business and personal on the same books, we don't have that problem because we're not shifting money from the personal checking to the business checking. We're just sorting out what the payments were once they clear the bank. And again, that's one of the pros of using one account. We don't have to deal with that kind of shifting the money from one checking account to the other checking account. And what does that look like within QuickBooks, because we're not using the two checking accounts in order to do that shift. So the next thing we want to take a look at, so the data in here looks correct. Now the next thing we want to compare is just how can we sort this data. Note that we always want to go back on this report where we have business and personal and make sure that there's nothing that's not classified. And once that's the case, then we can go in and start sorting this report in different formats. So in other words, if we go to the reports from where they're separated, business and personal, and we go to the profit and loss for the business, we get a profit and loss. This is separating out the months, but we get a profit and loss that looks pretty standard. We got the profit and loss, we've got the sales and the purchases just on the business side. When we do that on our QuickBooks file over here, if I want to say, okay, I want a profit and loss for the business and have it look, professional, we then could go to the profit and loss report by going to reports, company and financial, profit and loss standard, changing the dates from 02/01/20 to 02/29/20. That's February 1st to February 29th. And then filtering by going to customize reports, filter, classes, then change the class to business. And we may want to change the header or footer as well and just call it business in the header. So we've seen that a couple times, but just note, we could do that, get a professional report. It's a little more tedious to do so. We could, however, memorize it so that we can go to this report very quickly without having to go through those steps. Once we do the steps once, it should be okay and we should be good going forward. However, before we print this report, we want to go to this report and make sure there's no unclassified areas. And then we can go back over here and we can say, okay, this looks pretty much the same. We got the sales, the expenses, and we've got the same thing on our profit and loss, the sales and the expenses getting down to the 3,073. So that looks, pretty good, pretty professional report. It takes a little bit more work when we use the classes than if we had the separate files. If we had the separate files, we can generate this report just by making a standard profit and loss. If we look at the profit and loss for the personal, same thing. It looks pretty standardized. If we have a separate QuickBooks file, then we can just print the profit and loss, and it is what it is. On our side over here, if we had the business and personal in one account, we once again would have to customize it, go to the filters, classes, make it personal, and then maybe make the header personal. That's a capital E, that's okay. So then we'd go like that. And then from there, it looks pretty much the same, and we look pretty good going forward from that point. So we're at the personal I'd have to look at the personal for February, which is 7897, and this is 7767. And that difference is, of course, the 130 that we talked about before. So again, you can make the reports look pretty professional, pretty same thing under combining them or pulling them apart on the profit and loss. It takes a little bit more formatting if we're using the classes. However, it's probably the easier thing to do on using this format where we combine them is that we don't have two separate checking accounts, and we're doing that separation by using classes and accounts to do so. So those are the pros and the cons. If we look in the balance sheet, however, if we go to the reports up top, company and financial, and go down to the balance sheet standard, and we look at 12, or let's make it 02/29/20, so February 29th, 2020, then the balance sheet is where it's more difficult, once again, to break out. On the balance sheet with separate data, if we have two separate QuickBooks files, then the balance sheet will be broken out. However, if you use this format, we do need two different checking accounts in order to set this up. And the two separate checking accounts will force us to separate this data. But we also need to remember to use the two separate checking accounts in that way. And that's something that some people are very disciplined on and some people are not. So if you're very disciplined in being able to do that, separating, then the separate files will generate these reports very nicely. If not, then you're going to have problems with this paying back and forth. You know, this came out of the wrong account, and I've got to recategorize it when I record it in this account and make sure that the two accounts line up. And that could be one of the pros and cons between using two accounts, separate checking accounts, and one QuickBooks account with one checking account. But once you do this, it does set up the two accounts very nicely, and that's the point. On this side. Now it doesn't, again, this business account only has very minimal information, because no matter which method we use, we're still going to have to go back in here and give some more detail for the balance sheet, because the balance sheet's going to have some stuff that deals with timing, and that usually are areas where most small businesses need help. I mean, how are we going to report the loan on the balance sheet? How are we going to record if we have any accruals that we want to report on the balance sheet? If we have equipment, how should we report that, and depreciation? Those are areas where most businesses need help anyways, but there are also areas where transactions don't happen a lot. And on the income statement, those are the things that's where the activity is happening. That's where most of the day-to-day transactions are. So note, under either method we use, in other words, we're still going to need help to fix the balance sheet. If we're using just a cash basis method, we're still going to need to go back and shore up the balance sheet. But if we use the two separate accounts, it'll be easier for us to see the balance sheet separately. So all we have are these two accounts here on the business so far, because we've just entered data from the bank statement, but it's well separated. If we added the cash accounts up, we would say, okay, we've got the 4426 plus, and then if we go to the personal, we've got the 20172. If we add those up, it adds up to the 24,598. If we use the same data with just one checking account, we get to the same 24,598. So the total's the same, but we can't easily break it out between business and personal here because we only have one checking account. So it's difficult for us to break out between the two. And then we have the IRA, which is personal. So if we go back over here, that was on the personal side. So this is the personal balance sheet for the IRA. And so we can't really distinguish as easily on this balance sheet between the business and personal. It could be either. We don't have the classes to distinguish. We just kind of have to know if we were to use this method. Credit card, same thing. It's on the personal here. So we would just kind of have to know that as well and be able to break out between the two. And again, neither of the balance sheets are reported properly right now because we haven't included some other items. We haven't included things like on the personal, the mortgage, or the cars, or the equipment. So those are things we'd have to go back under either method and shore up. And then we've got the owner's equity. And if we take a look at the equity, then if we just think of it all as equity, all as total equity, we've got this 20,612 plus, if we go back to the balance sheet on the business side, we've got equity of 4426, and that adds up to 25,038. And if we go back to QuickBooks, we got the 2538. So we can think of it could break out a little bit differently, but remember that net income is something that should be rolling into total equity anyways. So if we're thinking about it as just a sole proprietor, then all equity is basically the net value of the company. So the total is what it is. When we go back and forth between the two QuickBooks files up here, we did use the equity accounts between the investments and the draws to help us kind of sort those transactions between the business again. This investments means it's money that came from the personal account that we put into the business account, and then the draws are the ones that came out of the business account into the personal account. So those are just some comparisons between the two. Note, of course, that this method where we have two separate accounts means that the balance sheet are going to be broken out well, and will be broken out on the checking account level, and we'll have to use, but on the cons, we will have to be good at breaking out two separate checking accounts, tracking two separate checking accounts well, and making sure that we remember to make payments out of the proper checking account. If we cannot do that well, then if we go to this method, it will still only have one checking account, which we can't easily break out between business and personal because we're only using one. But we can then go through the data that we're breaking out as we look at the bank statement and properly do our best at that point to break out between personal and professional, or between business and personal. And we can do that fairly well and come up to the income statement reports that are broken out by class on that level. And the income statement reports are typically the ones that we're going to be needing for tax preparation and budgeting, and the things that we typically think of for small businesses to track this information. For more accounting information and accounting courses, visit our website at accountinginstruction.info.